And we're here today on our Minorum YouTube channel with Jonathan Wellum, owner and operator of RockLinc Investment Partners here in Eastern Canada. As you remember, we last had an interview with him around June of 2014. We're talking about the global debt storm, and he's done an extensive presentation series that you can find on their YouTube channel, which I'll have a link to, regarding the debt storm. And what we discussed back then was the incredible amount of debt that was rung up from 2001 to 2007, which saw a rapid increase in worldwide debt ever since the 60s and 70s, actually, which ramped up from 2000 of $80 trillion to now well over $200 trillion. Now we're at a stage where Europe is having continued problems. They're in front and center of several issues with the euro debt crisis, again, still going on, with Greece coming close to a deal soon as well. It doesn't change the fact that there's still a growing global debt storm that stands over $200 trillion. Jonathan, how sustainable is this going forward?
Well, good to talk with you again, Sonny, and it is indeed a very interesting world that we live in. I think what's really materialized over the last number of years is that the growth in the level of debt has expanded at a much greater rate than the GDP or the underlying growth in the economy. In particular, productive assets. So in terms of sustainability, as we've grown debt at a much faster rate than the overall economies, it is clearly not sustainable. The only thing that's allowed the system to continue at the rate in which we've seen the expansion of debt vis-a-vis the expansion of the underlying economies is the lowering of interest rates. Mm-hmm. So the involvement of the central banks in bringing interest rates down to virtually zero conditions. And as we saw earlier this year, in some regions, we actually had negative yields for quite a few sovereign nations. And then the issue of the printing of money. So when you ask the question, is it sustainable? Absolutely not. But the issue is they've been able to kick the can a little bit longer than I think most fundamental analysts would have thought. But that's only because of aggressive involvement of the central banks and the fact that they've continued to be very aggressive. And I think the issue is, at this point, are they running out of options? We've stretched this about as far as we can. I think investors need to be very conscious of that and be very careful. And I think the situation, as we're seeing in Europe, you point to Europe, the Greece situation points to the fact that no one wants to take a write down. They're still in this mode of extend and pretend. And I think the reason they don't want to take the write down is because no one really wants to recognize that on their books and the stress that would put in the system, and that might encourage other people that want write downs. So that's where we stand, I think. And from our perspective, be prepared and be diversified, and make sure your investments are as best as possible protected from monetary challenges.
If it's not, and just as you said, I mean, it's not sustainable. It has some impact on the world economic growth. I mean, let's just take it a step further. Then, I mean, what we've seen with China, for example, they've had $3.5 trillion erased from the stock market in the last 4 weeks. They're at $28 trillion in debt as well. They're printing money. They're trying to convene in the markets as well. The U.S. is at $18.6 trillion in debt. We've had numbers come out from the U.S. in terms of job numbers that are quote unquote positive, and they've also looked for increased GDP numbers. But now with Canada slowing down, and just recently, I mean, just yesterday actually, they announced the reduction in their interest rate to 0.5% from 0.7%. The euro debt crisis is not the only issue, and it looks like India is seen as the gem of the world according to the IMF. So what is your analysis now in terms of global growth? How does that impact global growth?
Yeah, and there's no question that finding growth anywhere in the world outside of, you could look at, say, China or India, as you point out, is very, very difficult. There is very little growth in Europe. Japan is having a terrible time, as we know, and I think it's well advertised that they are in an economy where you've got more deaths than births. They're in shrink mode, if you will, from a demographics perspective, and their debt levels are just outrageous. So they're completely dependent on the printing of money in the Bank of Japan, buying the government debt, monetizing the debt. Europe, as we know, is not growing. Canada, particularly with the drop in oil, as that's really put us into a no-growth situation at this point, if any growth. I mean, very, very little. The United States, at best, is maybe 1.5% or 2%, and that's only when you have these monetary conditions where money is virtually free, and so there's no room for any kind of recession, and when I say there's no room for that, if we go into recession, we're already full tilt, full foot on the accelerator in terms of monetary policy. What do we do? And so your point is a good one. There's very little global economic growth, and when you look at China, they're doing everything they possibly can to keep that machine moving forward. We don't really know what the growth there. They say it's 7. Other people, when they look at more real numbers, such as the growth in energy demand and things like that, which give you a good proxy to economic growth, suggest the rate's maybe more like 4. So the picture is, I think, a tough one. So if you're an investor, you're certainly not betting on rapid economic growth. What you're looking at, in our view, is individual businesses, companies that are in unique spaces, niches where there's pockets of growth, new technology, areas where they don't need a lot of growth to continue to expand because they're in a privileged position. They're bringing economies or efficiencies into certain industries or businesses. So I think you really have to be very, very selective. And when you think of India, which often comes up on the radar screen, and we have some exposure to India through global companies. We do own some Fairfax Financial, and Prem Watts is very enthusiastic about India. But in our view, we're not there. We don't understand or know the market enough to make direct investments in India. And that's still a country that has tremendous corruption problems. And it's one of these economies that shoots forward, and it looks like you're getting some really good traction, and then you get a change in government, and then it sort of backtracks. And so we hear all the stories about India. We definitely want to be exposed to it through well-run financials that maybe are global. You can buy Nestle, you can buy some international staple businesses, basic infrastructure companies that give you diversification are in many regions. But direct investments there, we'd be cautious. But you're right, that's probably one of the only countries that's so young and youthful and coming off a low base where economic growth can actually be positive in a more substantial way than we're seeing anywhere in the developed world.
So what, with Canada reducing its rate, will the U.S. reduce or increase their interest rate, do you think?
Well, I agree with Mr. Grunlack, who was just interviewed yesterday, and the significant bond investor, that what we're seeing when we see Canada drop rates, we're seeing the rates dropped in a lot of the European countries. It's going to be virtually impossible, very difficult for the Federal Reserve to put rates up any more than maybe 25 basis points, which would be an absolute token increase, just to say that they increased. Because the U.S., first of all, is not overly strong. The other countries around the world are trying to get their currencies down, because that's really what our Bank of Canada wanted to do with the Canadian situation: drop rates, lower our dollar, try to improve our competitiveness when it comes to exports, our balance of trade. But if all the countries in the world are doing that, then the United States is hardly in a position to put rates up and attract even more money to their dollar. So I think that Janet Yellen is blowing smoke, and I think that she would like to get rates up a little bit because they're zero and they have no movement. If there is a recession, if there's a problem, which is highly likely in the near future, given the problems around the world, what are they going to do with rates? They're already basically zero. But I think they're trying to talk the talk, but I don't think they'll be able to walk it. And I think that we will not see rates increase. And if they do go up, it certainly wouldn't be any more than a token increase, which I think is almost useless.
What asset classes are overvalued, I guess, from an investor standpoint that we should kind of tread with caution? Is there anything out there that speaks out to you?
Well, I mean, in general, if you look at the different sectors, you can look at some of the biotech sectors. There's certainly areas in technology that are expensive. I think you want to be very careful about income-driven securities, so that securities that are reliant on very high dividends and income payments. Mm-hmm. That could be some of the infrastructure companies, some of the real estate companies, because if rates do come up, whether that is because the Fed raises rates or whether there's a concern that comes, there's a confidence concern, because rates can come up for a variety of reasons. You can lose control of rates also if there's a money problem. Then some of the most vulnerable assets would be those assets that are trading at the highest valuations because they're trading off of yield. I think it's a market where you've got to be very particular about every business you buy. What's the reason you buy it? Are you paying a fair price? Is the balance sheet strong? Is it in an industry that's pretty defensive and necessary? Is it creating true value? Because even in technology, there's some wonderful companies there that are creating value. And if there's a problem in the market, yeah, they might bounce around. But if they're creating good opportunities and cutting costs and being innovative, then they can still create value. The same thing in healthcare. I mean, there's a lot of money's gone into biotech. A lot of that it will probably be wasted. Mm-hmm. But if you're good in that area and you can find great companies that are going to come out with new products or drugs that are going to be, very important and shake up the landscape, you're going to have opportunities. So I think it's a business by business, and look and be careful. Don't go after companies that are trading off of hype, but fundamentals. This is a time for fundamental analysis more than ever. I mean, we're a fundamental shop anyway, so mm-hmm. of course I'm going to say that. Mm-hmm. But I think that in this market where the PE ratios are definitely extended, and you're in a vulnerable economic condition, then you want to be careful. I mean, the argument you hear from people is that PE ratios are just fine and the multiples are fine because interest rates are low and the economy is moving along. The pushback to that is, look, we've had 6 or 7 years of expansion. It's an expansion based upon debt, and low rates, right. Unsustainable trends, and therefore the business valuations are more vulnerable to pullbacks than you might think.
Right.
So be careful. That's our view, and so that's what we're doing.
Well, if you come back even to in terms of global printing and debt, I mean, you're seeing a lot of countries in Latin America having a lot of trouble as well, including Brazil, Chile, Peru, Argentina. There's a lot of debt being created there, and they're in a very vulnerable position as well. That would be something to look out for. So, you've given some aspect in terms of how the equity, what are some asset classes to stay away from, and what to look at.
When I say stay away from, be very selective.
Selective, okay.
Very selective in those sectors. So it wouldn't be say stay away, but there's some of these sectors that have really done well, and the good and bad have gone up. Be careful. If you're in some of the sectors that have been, the sexy sectors that have done well, go back to the business. Make sure it's there. Make sure they can grow. Make sure that through adversity, there's still going to be demand for those products and services of that company. They've got a balance sheet that can weather, difficulties.
And I guess just to finish off, then how, you've looked at several opportunities in equity markets today. I know from our last call, you really looked at, with all this printing, that gold is money. So you've seen some opportunities in the equity markets apart from the precious metals sector. What are some things you're looking at? Do you still believe that gold is money still, and do you still think it'll make a strong role going forward? And what do you see in the equity markets today? What are some things that have caught your eye in terms of investments there?
Yeah, in terms of sectors, we are continuing to look for properties in the agriculture, so food. There's a whole chain of value there. We own innovative finance here. We like a small streaming company called Input Capital that trades here in Canada. Mm-hmm. And I think they have a very innovative financing model for farmers that's much better than bankers. We like in the water industry, and we own some of the larger players, everything from a Pentair, which Nelson Peltz has now got to, and he wants to be actively involved, to Xylem, to Ecolab. So looking at, businesses there, a number of infrastructure companies. The Brookfield guys we like, they can raise capital and deploy it well, and they'll be able to do that in difficult times. So we spread around a number of industries. In the technology area, we've stuck a larger company, so we own Google. I just saw the numbers just got released just a few moments ago, and they're making a lot of money, and it's been one that's sort of been in the doghouse, if you will. And we think it's relatively inexpensive. Look at cash flows. So we're looking across all those areas, but we do maintain and are absolutely committed to the gold and silver space in particular. Those are the precious metals we can find good businesses in that we can get our minds around, because we do believe they're monetary substitutes. And the more negative the sentiment, the more we get excited about the area. Mm-hmm. And so we're not put off by, conventional wisdom or conventional thinking, if you will, at this time, which means they're irrelevant. No, the reason we have money printing, the reason why debt is escalated, because we don't have discipline in our monetary system. And part of that discipline in the past was a gold standard, which would keep things on track. And so we do believe that in a reset, which will have to take place at some point, we'll have to reset a lot of our obligations. We can't just kick these forever. Then gold and silver be important, and buying businesses in that space is a good idea. And right now, we have seen over the last 4 years one of the biggest divergences between equities, broader equities, the non-precious metal equities, if you will, the S&P 500, and the impact on the prices in the precious metals. I mean, there's been like an 80% divergence, plus. Mm-hmm. And so the miners are trading at record low prices. Even the companies which we own mostly, which would be the streamers and the royalty companies, some of them are in the doghouse too right now, even though they are very strong businesses with no net debt, good cash flow. And so in our view, this is a market that if you understand miners and you're a good geologist and you know that area, which is not us, but if you do know that area well, some of these companies are amazingly cheap. And if you can do your research or find people who can, it's a good opportunity to just pick away dollar cost average in the best companies with the great resources, great reserves, low cost production. For us, we continue to put most of our emphasis on Franco-Nevada, Royal Gold, Silver Wheaton, and also Sandstorm. And that's because we're finance guys. We're not experts, so we look to those companies to be able to do the deals. And we've talked to 3 of those companies recently, and they're doing deals. And this is the perfect environment to actually create revenue, royalty and streaming contracts when the market's kind of negative on the space. So we do not want to run from it. We keep a 6% or 7% weight in our portfolio. So and if anything, at this point, I'm looking at actually taking it up because the valuations are just so compelling in that space. Yeah.
Well, that's great. Well, thanks, Jonathan, again for giving a rundown on your outlook in terms of the markets and how this global printing is just it's getting a little bit out of control. However, that's the market we live in today, and I guess we'll see in the next few quarters how it shapes up. But thanks for your time. If you do want to get in touch with Jonathan, please contact or get in touch with through his website at RockLinc.com. We will be providing the information for that, and he'll be more than happy to have a conversation with you. And is there anything you want to add, John?
Well, I just to reiterate what you've said, Sonny. Look, we live in highly unusual times. This is not normal, And so please, investors, don't get lulled into complacency. Be vigilant, be careful, understand the businesses you're buying, keep adequate diversification across a few different sectors, but don't forget the gold and silver space. Buy the best companies and buy with knowledge, or look to the companies that are offering good products in the space that can give you some diversification. These valuations are amazingly inexpensive, and yeah, they could go lower, but we all know the cycle. They can also bounce back, but buy the best businesses, buy the cash flow, buy the businesses with the best people, and that's also as you know, very important. You're ultimately buying people and their ability to execute and allocate capital.
Excellent. Well, thanks, Jonathan, for your time. Again, we'll put a contact information there. You can reach Jonathan anytime that sees fit. Thanks, Jonathan.
Great. Thank you very much, Sonny. All the best.
Thank you.